Hello, welcome to this episode of Rich Insights. I'm Don Rich, Head of Investments for Esoterica Capital Markets. Today's topic is on the negative price of oil. All right, what do we make of the negative price of oil that we witnessed today? Now, we have cautioned you for the last couple weeks in particular about the strong possibility that oil prices could be falling. And in fact, that happened today. So let's see what to make of this. We're going to start with the charts, all right? What we have on the chart here is what's called the term structure of oil. All right, so what we have is people buy and sell oil to be delivered in 1 month's time, all right? And there's also oil to be bought or sold 2 months from now, 3 months from now, and so on and so forth. All right, so this orange line is what's called the term structure today. The blue line was the term structure at the end of March, into the previous month. Now, the negative $40 oil that we're talking about was just a nearby contract. All right? It wasn't the entire oil curve, just a nearby contract. Now, you can see at the time that I made these charts, it was no longer negative $40. It had recovered a bit here to negative $14. All right, so the good news is it was just a nearby contract for oil that collapsed today, went into negative territory. It was not the entire oil curve. But that does not mean it wasn't important. All right, I think there's at least 4 things we can draw from this. All right, first is the fact that we are in highly unusual times here. In the middle of this coronavirus, the magnitude of the demand destruction, it's been historic, unprecedented, whatever word you want to use. We were already in uncharted waters. Now, to add negative $40 oil to those uncharted waters, wow, right? That raises the hair on the back of my neck. Adjust your risk accordingly in your portfolios, because to have those two moons line up at the same time, that concerns me a lot, all right? So the first thing is risk taking. The second thing is somebody was on the opposite side, on the wrong side of the negative $40 oil today, right? And there could be some contagion effects there. All right. The third thing is just risk taking in general. Now, whether it's a hedge fund, whether you're buying on margin, whatever form of credit we're talking about, if the risk analytics were set up assuming the prices could not go negative, all that went out the window. All right. Everything has to be readjusted. And the price of borrowing, the price of credit is likely to go up following today, and the amount of credit is likely to go down following today. All right, that's the third insight I would get from this. Now, the fourth insight is I ask myself, what's prevent this from happening again? Was there something terribly unusual about today's events that make it unlikely to happen again? And I don't think there is. In fact, I expect the next contract, which would be the June contract here, to be under pressure. Now, I'm not saying it's going to go to negative $40, but I'm also saying it's unlikely, in my opinion, that it's going to stay at $20. All right. Now, why is that? Well, the demand destruction continues. Right. This unbelievable demand destruction associated with social distancing continues. All right, that's the first thing. The storage capacity is limited. Oil storage capacity is limited. Right, that's the second key feature. The third is oil inventory levels were already quite elevated going into this. So we didn't quite max them out this month, but we definitely look like we're going to next month. And then the fact that there's no supply or demand disruptions coming. I don't see anything changing the paradigm we're in today. So I don't see anything that would suggest that we cannot repeat what we just witnessed today. So again, I want to highlight the demand destruction. These are the charts I pointed out last week. I just want to run through them real quick. They haven't been updated because there's been no new information to come through. So let's go back to the charts here. This is gasoline demand, again, falling off a cliff here, unlike anything we've ever seen. Gasoline inventories, all-time highs. Oil inventories, not at all-time highs, but close to it, right? That's concerning. Oil demand, falling off a cliff. All right, that's what I'm talking about. The combination of the demand destruction with the elevated inventory levels is, it was a problem today. It's going to be a problem in the future, I think, as well. All right, so that's our message for today. I'm Don Rich. You just experienced a rich insight. I hope you've enjoyed it. May your beer be colder than the company you keep. We'll talk again soon. Thank you.